All right, ready? Hi, everyone. Welcome. I want to welcome you on behalf of the DAYL CLA Committee and myself, and thank you for being here today. I am a member of the CLA Committee at the DIYL and a practicing or a tax attorney. I am the Vice President in the tax insurance practice at CAC Specialty. And if you've never heard of tax insurance before, you're in the right place. You're going to learn about it today. I graduated from SMU, and prior to joining CAC, I worked at Thompson & Knight as a tax attorney in both their tax controversy and tax planning department. And the DAYL is very excited to host 3 of my distinguished colleagues today, each of them an excellent lawyer and experienced insurance broker. They work each day to transfer risk away from their clients and into the transactional insurance market. So today they're going to be talking to us about 3 transactional liability insurance products: reps and warranties insurance, tax insurance, and contingent liability, which is a litigation insurance. Each of these products has become increasingly more common in M&A deals and then outside of such transactions in the ordinary course of a business. And so they're here to explain that to you today. And thank you all for being here. We just want you to know, please feel free to ask any questions you might have in the chat throughout as we work through, and we will have a little time at the end too to address them. But we hope you enjoy the presentation and find it informative. So I'm going to turn it over to my colleagues, Michael Wakefield and Matt Movafagi and David Barnes. Thank you guys for being here.
Of course. Thanks, Jessica. Hello, everyone. I'm Michael Wakefield. I'm sitting here with David Barnes, so I'll let him introduce himself. Quick intro for me. I went to the University of Texas School of Law, so I've spent a lot of time in Texas. And clerked for a Fifth Circuit judge, practiced law at King & Spalding, and then jumped into insurance brokerage now 7 or more years ago. And we can get into some more interesting topics on that front as we go. Matt?
Yeah, Matt Movafagi here. I also went with Michael Wakefield to the UT School of Law. I practiced in New York after graduating at Wilkie Farr & Gallagher as a tax attorney, where I represented private equity funds and their portfolio investments. After about 5 years, I went in-house to Chevron, and I worked for 6 years before I became a tax broker. And I was responsible for implementing sophisticated tax planning strategies around the world. David?
Yeah, thanks. David Barnes. I had the pleasure of working with Michael at King & Spalding a few years ago before I jumped into the insurance brokerage world at his recommendation, call it 5.5 years ago. I'm a Vanderbilt law grad, so don't hold that against me. But the insurance brokerage world has been a really fast, fun place to work over the past few years. So if anybody in the audience is kind of wondering what they're doing in the law firm world, feel free to give us a call. We'd love to chat.
Yeah, and so to frame our conversation today, we all are part of a specialized insurance brokerage. So insurance brokerages can range from selling life insurance to selling complex, bespoke, built for the scenario products and solutions, and we are on that far end of the spectrum. Our team specializes in representations and warranties insurance, which we're going to talk about, tax insurance, which we'll also talk about, and then contingent/litigation risk insurance, which we'll talk about last. David and I have been partners in this business for a long time, and he and I would both claim some expertise in rep and warranty insurance, and he also co-leads our contingent risk practice. So I'll probably do most of the speaking on reps, but David can jump in and correct me where I get out of line, and then Matt will speak to tax insurance, and David can talk to contingent. And that is your overview, and we'll make time for questions. And also, I believe you can send questions in the chat as we go, but we'll also make sure you have a chance to ask at the end too. So the first big picture, transactional liability insurance is used by deal parties to transfer risk out of a corporate M&A transaction. Now, there are several, you'll hear some exceptions to this where for example, tax insurance applies outside of an M&A context, but generally it's fair to think if we're in corporate mergers and acquisitions world, there, you know, the whole purchase agreement negotiation effort is largely an effort of shifting risk between the parties and allocating risk by the contract between the parties. Transactional insurance lets parties take risk away from them and onto an insurance carrier, obviously for a premium. And that's how the market grew, really starting with rep and warranty insurance. So you can, you know, this deck can be a lead behind too, and I won't read it out loud to you. But as you think about using transactional liability insurance, we use for unknown risks, so, and that's where rep and warranty insurance really helps, where the buyer does a lot of diligence of the seller and all the reps the seller is making about the target that the buyer is buying. And if those reps turn out to be not true after closing, that causes loss to the buyer. The insurance policy pays that loss. We'll get into that in detail in a little bit. Transactional insurance can also be used for known risks, where you have, for example, a piece of known litigation, a known tax matter. And so those are the two major buckets we think of: unknown risk and known risk. Jessica, if you don't mind going to the next slide. So this is a slide that David and I have been using some version of for many years, and we think that it's the best visual way, starting from scratch, to think about rep and warranty insurance. And I'll just say, we have a potentially broad audience. Some of you might do rep and warranty insurance every day. For those of you who don't, I hope this is helpful, and forgive if this is in any way patronizing to people who do it every day. But this is a useful way to think about it, even if you're familiar with the product. So in a deal without rep and warranty insurance, you can tell if you look at our percentages here, the blocks aren't the right sizes. That's so you can read it and tell what we're doing rather than to try to be representative. And typically, say we have a $100 million deal. I'm the buyer, David's the seller. I'm going to pay him $100 million for his company. In a deal without rep and warranty insurance, I will often agree with him to pay him $90 million now, and then to take $10 million of my purchase price, put it in an escrow account. So a neutral third party holds that money until usually about a year after closing. And then if a year after closing, if I haven't discovered any breaches of the reps he makes me when we close the deal, that money will be released to him. If, however, there's, let's say, he represents my company's financial statements are kept in accordance with GAAP and they accurately reflect the status of the business you're buying. And then it turns out that I do an audit halfway through that first year and discover that, well, here are 3 ways that you weren't accounting appropriately under GAAP. And that changes the value of your business. Now it's a $93 million business instead of 100 based on the breach of that rep you made. I would hold back money from that escrow, and we probably argue pretty hard about it. And Glenn, David and I have been involved in some litigation where parties have gotten pretty nasty in those kinds of disputes, and ultimately reach resolution. And he gets $3 million released to him, and I keep 7 because I was damaged in that amount. The basic concept of rep and warranty insurance is you're replacing his risk, that $10 million that he's putting at risk, with an insurance policy. And that's where you see on this slide the red. So you go from seller bearing significant risk to the insurance policy bearing almost all, and in some cases, all of that risk, with the exception being a deductible or what we call a retention in rep and warranty world underneath the policy. So if we have, so to give you that same example using rep and warranty insurance, I pay David $100 million now, and he walks away usually clean with no further risk. He and I decide who bears a retention of about $1 million, so about 1% of that 100 million enterprise value. And if we have that same $7 million loss, you go through the retention, so that's 7 minus 1 million, and then you have $6 million of loss that the insurer pays. So it's really taking that risk off of David onto the insurance policy. All right, any comments? Do you feel like you're getting a better deal?
Yeah, I mean, it's obviously a better deal for me in this scenario. I get more of my money sooner. I'm less likely to be on the wrong side of a V in a court proceeding, etc. So
Right.
Great deal for me.
Yeah, so Jessica, that's a segue to our next slide, if you can skip there. So this this is also interesting from our perspective, at least. It's a slide that we've used a lot over the years, and how we talk about this slide has changed. At the beginning of rep and warranty insurance, that benefit to David that we just described in our deal context was the big driver of rep and warranty insurance. So private equity firms do deals, they want their money now, they don't want to have that $10 million tied up in escrow. They want to move fast, distribute their profits to their shareholders, raise the next fund, tout their returns, do all the things that the fast money moving world wants to do. And so you really look at the right side of the slide. Why do sellers want to use rep and warranty insurance? It's, we just kind of went through that, so I think you get the point. Interestingly, though, over the last few years, I would say the use of this product, or the reasons for use of this product have shifted some to the left side of this slide, where you have the buyers. And why do buyers want to use rep and warranty insurance? We have more and more often we hear from buyers saying, I don't want to have an escrow where the party that money would be released to, the seller, is now, my management team. I buy a company, I keep the CEO on, and if I make a claim against that escrow, I'm going to be fighting with my own CEO, who's my partner going forward in the business, and there's a lot of bad things that come out of that. They also say, I think that the insurance companies in this space can be more reliable claims paying sources than parties on the other side of an escrow. And back to our, David, again, going back to that same example, we've had at least one very nasty situation where the seller did not want to release the money, and that was a much worse claims process and result than when you look to the insurance policy. And so I acknowledge that everybody has, well, many people have some level of skepticism of insurers paying claims, but in this space, we'll defend that all day and feel pretty good about how the industry's handled it. And then you have a few smaller ones. The lenders sometimes want rep and warranty insurance, et cetera, but those two don't want to fight with my partners / management going forward, and would rather collect from an insurance company, and really shifted this towards buyers wanting the product.
No, I agree with that. I mean, the products has really found its footing as, hundreds of millions of dollars in claims have been paid, and, repeat law firms are seeing that claims are getting paid when they're viable, true claims with viable damages models. They're getting paid, and there's a business relationship for carriers to want to pay claims because they want to be known as sort of commercial claims paying carriers in a competitive market. So I agree with all that.
Yeah. All right, move forward. So we get a lot of, and by the way, we could do a whole presentation on claims. We've done whole presentations for an hour and just talk about claims. We both have some experience fighting with insurers over recoveries, and so clearly happy to field any questions about that. Process is a question. So we'll still get calls occasionally where the buyer says, is this going to slow my deal down? I mean, I'm really worried about the time crunch. You have to introduce an extra party. I only have 90 days until I close. And at the beginning of that sentence, we get a little bit worried because we think they're going to say we want to close in the next 24 hours. But if you have 2 or 3 weeks, we've never not been able to find coverage. And our goal, of course, is as brokers, service providers, is to never be a reason that a deal gets slowed down. So we have on this slide what we would say is an ideal process. We've found coverage from start to finish in 3 or 5 days. That's not ideal because everybody's moving faster than they want, and people on both sides are stretched thin and can miss things. Longer than this is obviously easy because you just add extra days where less happens. But if you're looking at what takes time and where the time is spent, this is a pretty fair example of how things go. So we get a call on day one, hey, I'm under exclusivity, I have an LOI to buy this company. We get NDAs taken care of. We as the broker and underwriters are very willing to sign non-disclosure agreements, et cetera. So we check that box. We then, the broker, go get quotes for the buyer, and we bring those quotes and a package summary. We summarize, analyze, provide a memo to our clients that says, here are your options, here's where coverage differs, here's where pricing differs, here are other factors you should think about. As a broker, a lot of what we talk about is market relationships and underwriting service levels, those kinds of things. Pick an underwriter, and then once you pick an underwriter, you're into the true underwriting of policy. And that's probably simpler than you might assume if you haven't done this before. It's really the underwriter getting a packet of the buyer's diligence reports. So that's a financial or quality of earnings report, tax report, legal diligence report, and depending on the industry, sometimes others. And the underwriter reviews those, prepares a list of questions for a call, hosts a call that's an hour and a half to 2 hours. And then after that call, we have some number of follow-up questions. We like the deals where there are 3 follow-up questions, but sometimes diligence hasn't, we were still waiting on answers from the sellers, or for some other reason, they're open questions, and you can have, 20 follow-up questions. You then address those over the next few days and bind coverage at signing. Alongside that are policy negotiations. Many or all major law firms typically have pre-negotiated policy forms with each carrier. And these, I don't know if you've dealt with insurance, you've probably seen admitted policies where you have a form approved by the state, you have endorsements. If you want to change the policy, you have to go negotiate an endorsement. Here, because this is insurance kind of down a rabbit hole, so you don't have to understand this, but these are surplus lines policies, which for practical purposes means we're negotiating a contract with the insurer. So every time we go to negotiation, it's a contract negotiation. The law firm gets involved. We aren't providing legal services, obviously, as a broker, but we have a lot of contract expertise from our days practicing law, and we work with the client and law firm to negotiate the best coverage available. Do you have anything to that?
No, I would say don't let it be a hold up if your firm doesn't have a negotiated policy form. We have negotiated policy forms that we've used on tons of prior deals. We can assist in that process. So if you're saying, I don't want to go do rep and warranty insurance, or there's any sort of reticence to use rep and warranty insurance because you've never been through the process before, don't let that slow you down. We work with a lot of first-time buyers.
Yeah, and as an example of that, we'll get asked a lot, can you just send me a sample policy form so I can understand what I'm getting into? And that's always a hard question for us, because the answer is we can email an underwriter and say, give us your off-the-shelf specimen form. But every policy we find looks very different than that, and much more favorable to our client than the off-the-shelf form. So the point is that they're heavily negotiated, and there's more available in the market than you get off the shelf. Agreed. So it's worth noting, we don't have to spend much time here, but it's worth noting that this is a very competitive market. And if you're familiar with other lines of insurance and who the big insurance carriers in the US are, and then you look down this list, I think what you'll notice is a lot of these are brand names that you wouldn't recognize. The reason is it's common in this space for what we call managing general agent or managing general underwriter to underwrite on behalf of large insurance carriers. Again, that's another insurance rabbit hole, but the point is we have a lot of companies competing for these deals, and this is kind of the value we bring and what we do. We jump into this brokerage world. One of the things that we think we can add value by knowing and doing is understanding this marketplace and which of these underwriters is willing to underwrite certain kinds of deals and is flexible in underwriting, et cetera. So it's a pretty complex marketplace, and we spend a lot of time staying up to speed on it.
Yeah, it's changed a lot. I mean, we had some carriers exit in the last couple of years, and we've had several more enter, which is great news. Obviously, net positive number of warm bodies behind desk able to underwrite deals, substantial capacity. I mean, you can do a $1 billion insurance tower in the rep and warranty space if you wanted to. There's plenty of insurance capacity out there.
Yeah, and I think I can think of 2 underwriters we've ever removed from this slide, and we seem to add one every few months. So it's interesting. We get something that we think about hard is how to put our clients' risk with stable, reliable insurers who are going to be in the space. You never want to have an insurance. Well, I'd say never. It is never ideal to have an insurance claim where the insurer no longer has a reputational risk in this industry. So I won't even say a name on this. Let's just insurer A underwrites rep and warranty insurance, issues your policy, and then exits the space, says, we think it's unprofitable, we're not doing open warranty insurance anymore, and then you have a claim, that's not good for anyone on the side, the policyholder side, because you can end up, we can make some calls and help in the claims process by saying, show us how good you are at claims, we'll send you more business. This is a long-term relationship. But if the insurer has said there's no more relationships, we don't do this anymore, some of those soft factors stop helping. So we think hard about commitment to the space, et cetera. So sorry, go ahead. Last thing, I know we need to move on to tax. Quick market update. This is more for those of you who are in this market, because without prior context, this might not mean as much. But very, very briefly, at the end of 2021, we had this huge inflection point in rep and warranty insurance. The market was flooded with submissions. Underwriters couldn't get to deals. Every broker got declinations for bandwidth. Our team doesn't have enough time to get to your deal. And that led to higher pricing. So too many deals means you have 10 good deals on your desk. Underwriter says, I can do 2. They know the clients are more desperate for quotes. And so they say, well, instead of charging you $300,000 for 10 million in coverage, I'll charge you $500,000. And that's essentially the cost of my time. That's a dynamic that's always gotten under our skin. We think that pricing should be driven by risk and losses paid and loss ratios. But that is just a function of the rep and warranty market that we're having to work through. So the market is staffed up in response to that. There are now, like David said, many more, better than warm bodies, smart professionals, right?
Yeah.
Many smart professionals in the underwriter chairs. And as of now, as the deal market has tapered off a little bit, or cooled down a little bit, we have a lot of appetite for every deal. And by the way, from our perspective, we are very, we never want to tell the client, sorry, the market's too busy for your deal. And we never had to, but it just took a lot of calling in favors. So I know some deals didn't get done, but we were very committed to getting all ours done. That was another part, element of being a broker. That was a really tough time for everybody in the market. So again, we have competition. Rates got high. When you think of rates online, it's premium divided by limits. So your 500,000 divided by 10 million is a 5% rate online. We saw a lot of deals in the 5 to 6% range, which I think is very high. Now deals tend to be back to 3 to 4%. And we're having more leverage on our side in selecting an underwriter to negotiate creative structures, better pricing, things like that we didn't have as much in Q4 because we were scrambling to find quotes for our clients. And then we alluded to this last point, underwriters coming in and out. That makes us very sensitive to who has claims paying experience, who has a claims paying setup that is appropriately arranged to pay claims and adjust them fairly. And sometimes that's what we have when we're looking at a newer player. We don't want to ding new players, but they need to be thinking about it right and thinking about long-term partners for our clients. And then my sort of read the tea leaves prediction is that because of that glut of policies at the end of 2021, that I think may have been underwritten in haste. I don't know if that's
Quickly.
Yeah, quickly. Maybe
Everybody's moving fast.
Yeah, people doubled and tripled the number of deals they were working on at a time. I think claims will come out of that just numerically, and I think you add to that the fact that maybe underwriting was a little bit different.
And honestly, I mean, maybe diligence on behalf of law firms was a little different than it typically was, just because everybody was running so hard. If you were in the transactional world at the end of last year, everybody was running fast.
Right. So I think by this time next year, maybe by the end of this year, we're going to have everybody's focus is going to be, oh my goodness, these claims have come and who's handling it well, what insurers are saying the claims are too much, and we're going to exit the space. I don't want to say that I don't think the sky's falling for any insurer, but I think that'll be a big topic. So, all right, moving on, Jessica. Thanks. All right, that's our reps overview. Feel free to ask questions, but we want to move to our topics here. And Matt, I'll hand it off to you to talk about tax insurance, my favorite topic.
Definitely my favorite topic. Thank you very much. And if you guys have questions, please feel free to interrupt either during or we can answer them at the end. Tax insurance, start off very generally, is primarily designed to protect a taxpayer against a tax loss arising from a tax authority's challenge to a tax position. I know a lot of taxes mentioned in that sentence, but you're going to hear it quite a bit. And it basically allows a taxpayer to execute an underlying transaction with complete financial certainty. So you get level of comfort similar to someone reaching out to the IRS and trying to get a private letter ruling on the issue, or just being able to be sure that the issue is correct and you know how much it will cost. And since tax insurance is designed to make an insured completely whole in the event of a challenge to the tax position, it covers taxes. Also, there can be additional taxes. There can be interest and penalties and contest costs. And the contest costs are the costs to defend the position against the service or a tax authority's challenge if it's not the IRS. It also covers things like gross up, which are the taxes incurred because of the receipt of proceeds are likely income to the recipient. Effectively, it's a risk management tool that you can use to transfer the economic risk of a tax loss to the insurance market. And as a broker, we help, just like they do in the rep and warranty space, we help provide a submission and kind of take that to all of the markets that are available. And tax insurance has really grown and exploded over the last 5 years. Just to give you a sense of how much it's grown, about 5 to 6 years ago, there were only 2 to 3 insurers kind of on the list that Michael provided a few slides ago that could actually provide insurance on tax issues. And there was maybe 150 to 200 million of capital for any one US tax risk. And only US tax risks were covered, and only if they were very strong level of comfort, like a should, 65% or more on the merits. There are now more than 10 primary insurers and probably 20 primary and excess insurers with capacity of up to almost 2 billion on any one US risk. So the market has just kind of exploded with both the number of insurers and the professionals that are in the space, like Jessica and I got into the space, and the insurer space. There's also a lot of tax practitioners there as well. And that has driven down prices quite a bit. So the capacity was increased, and due to the increased capacity, the prices have come down. So what would have cost 5 to 7% 5 to 6 years ago now costs 2 to 4% of the limits purchase as an all-in cost of insurance. So if a company is trying to insure 100 million of tax loss for a US risk, you will likely be charged somewhere between 2 to 2.5 to 4 cents on the dollar. So 2.5 to 4 million as an all-in cost to provide insurance for that. In addition, it's not only US tax risks that can be insured. It's state tax risks, it's income and non-income taxes, it's VAT, withholding tax, et cetera. And this isn't just for tax practitioners to understand or maybe use as another arrow in their quiver of some way to help. You can use this as and what we'll talk about as an M&A attorney. When tax issues come up, you can use it as a bankruptcy attorneys. We've worked with them, and I can talk about that a little later, and state and trust and estate attorneys as well, in addition to litigation attorneys, especially if you're litigating a tax dispute. So there are 3 main categories of tax insurance. And the first one that we're going to talk to is M&A transactions. And this kind of complements rep and warranty insurance. And so how it complements it is, Michael said, rep and warranty insurance covers all the rep and warranties, including tax representations that are made by a seller in purchase agreement. And that covers all the unknown risks. Typically, any known risks identified during due diligence are then excluded from that, and they might be like scheduled and whatnot. And as a result of the exclusion, the buyer and the seller are kind of left with a gap. So there are a few alternatives, right? The buyer could self-insure the issue. They could request a purchase price reduction, or they could seek a separate tax indemnity from the seller and maybe escrow it for that one issue. However, given the seller believes that his tax position that it took is correct and probably doesn't want to hold back any of the proceeds, and the buyer doesn't want to take any risk related to this, tax insurance is a great solution to come in and bridge that gap between the buyer and the seller, and put it to the insurance market. Again, it's all about risk allocation. You're just kind of changing it. It's a good competitive tool that you can use by a buyer or seller as part of an M&A tax transaction. And we have 3 buckets that I'll touch on briefly when we kind of categorize things. The first is can be reduced. Tax insurance can be used in M&A transaction to reduce historic positions taken by the target. That would be if they're taking any tax position that they've taken over a period of time, like debt versus equity treatment on an issue, deduction versus capitalization, or employee versus independent contractor. That's kind of how we bucket that one. The second one is issues arising from the transaction itself. Sometimes there'll be restructuring, maybe it'll be a tax-free reorg, that can provide tax issues that can come up. And third, it could be used an M&A transaction to ensure the transaction, the target itself. So typically we'll see an M&A attorney coming to us because a seller has an S corp and the buyer says it wasn't a perfect S corp because no one's ever seen one, and there's a tax issue. Neither side wants to budge, so can we get a tax insurance to kind of bridge that gap? So those are the three in that space. So that's the first kind of category: tax insurance and M&A transactions. And tax insurance is a risk management tool in a company's ordinary course of business is what I'm primarily focused on, what I'm really excited about in the tax space, and that it can just be used by companies to, help with any sort of contingent risk in a company's ordinary course of business. And Jessica and I and any other tax attorney has good employment prospects because the tax code is so complex. And despite receiving advice from attorneys, accountants, the proper tax transaction of a transaction may be uncertain. Maybe there's no clear guidance on the issue, or the fact pattern is unique. And we can come in with, an opinion on the issue and help get a company tax insurance, which will kind of remove the uncertainty from whatever contemplated planning and provide the board of a company or the decision makers with certainty that they can kind of move forward. I think it's worth noting here that tax insurance can be purchased either before or after a tax position is reported on a return. For example, if they executed something in 2018 and they're worried about it, they can get insured now. It's also worth it in the litigation context to understand that you typically with insurance can't insure a burning house, but you can, in fact, while you're under audit, or even if something is going to a hearing. We're working on an issue that is going in New York State court that's working on a hearing to get insurance for that. And that can be placed. It's not quite as cheap as the 2 to 4 cents on the dollar. And it doesn't cover things like contest costs since you're already fighting it, but things like that can be placed. I mentioned bankruptcy earlier. In the bankruptcy context, if there's like a tax receivable or a tax refund that a company is waiting on, you can put insurance in place to make sure that an administrative judge will sign off on releasing funds, or if they don't know if an issue is going to be audited, of releasing funds to creditors, and they're happy to get their 96% of their money up front. Similarly, in a state, if they're hesitant to release funds to beneficiaries because they might want to protect and not have to claw back money in case the IRS says you didn't file a tax return correctly, you can come in and place a policy to kind of protect against that. In each of these instances, it allows entities to kind of execute a transaction and know what they're going to get out of it. I think it's also known, I mentioned something called a private letter ruling, but that is one way that companies get complete certainty about their finances and about their tax issues. But the IRS is really slow on that. And basically there was a study by the tax inspector general for the tax administration a few years ago. And basically they're about 9 months behind. And there's almost no company that can wait 9 months if they know they're in an M&A transaction or they know they want to take a risk. And so tax insurance is a great way that companies can kind of get this risk hived off in 2 to 3 weeks, depending on the transaction. And companies really want cash flow and want to be certain about cash flow, want to be certain about their books. And in legitimate commercial transactions, it's hard for the IRS to work. While they may be very efficient, it's hard for them to work and operate in real time to provide that kind of certainty. But tax insurance is that kind of solution that can provide that certainty and is that alternative.
One question that I've heard a lot from clients and prospects and others is, isn't it kind of like raising the specter for the IRS if you go get tax insurance on a position that you're taking, and doesn't that like sort of cut against the chance of your success? How does the market, the tax insurance market, answer that question?
Feels like a softball question.
Yeah, well, so yeah, I mean, it is kind of a softball question, but first of all, generally when you get the insurance, you kind of say you're going to defend it without noting it. So the IRS doesn't necessarily know that there's insurance in place for it. And tax insurance can cover all transactions. However, we won't do certain types of reportable or listed transactions. So, I mean, to answer your question, they don't really take that risk when attorneys kind of are writing their opinions, they can't take into account audit risk, right? When you're getting an opinion on a tax issue, they have to understand that all the facts are in front of a judge and it's based on the merits. But when tax insurance comes in, they do get to take into account audit risk. So was that exactly the question you asked, or did you ask something slightly
Yeah,
different?
no, that's part of it. I mean, another thing that I've heard from some of my mentors in the industry on the tax insurance side of things, before we hired smart folks like you, was that look, it's the opposite is true. It's not that you're insuring it, and the IRS should therefore say, well, they must be worried about it. So
That's the softball question you're going for. No, I mean, that question is, I mean, the IRS in 2002 actually stated and put it on proposed regs that they were going to say that the tax insurance would be reportable, and that would have a chilling effect on the market. And someone from Concord Specialty, a guy named Dave DeBerry, who's kind of known as the grandfather of tax insurance, went and testified in front of the Senate Judiciary Committee and kind of said, no, tax insurance is here. It's not for tax avoidance. It is to help with tax avoidance, but it's not helping with tax evasion. No insurance company is going to put their good capital behind a bad risk. Insurance companies are here to make money, but this is to help a company that may be conservative in its space, and they just don't know if there's a more likely than not toss up, and maybe there's an asymmetric risk reward, like you have a $40 million tax issue, but if it goes south, it could cost you $100 million. That's a great risk to bring to the insurance market. It may only cost you $2 to $4 million to place the insurance risk, but it's a good risk. The insurance companies think you'll win on the merits, and you're saving the shareholders $36 million still.
Yeah,
and so companies,
you could almost argue to the IRS, the IRS should view tax insurance as an extra confirmation that this is a good risk. Like this is a good risk.
Not only is there capital behind it that's going to fight it to the end, but exactly right. You've had a bunch of tax attorneys and tax practitioners along the way, and in addition to companies counsel and companies in-house, then you have brokers on our side looking at it, Jessica and I digging into the code. Then you have underwriters that are in the tax space that are either attorneys or tax practitioners, and then you have their outside counsel. So you already have at least 5 or 6 levels of tax practitioners have looked at something. So to that sense, yeah, I think it's almost safer if you can say you're able to get insurance on an issue. So good question. After tax insurance, there's also one which I'll only briefly touch on, is tax insurance for energy tax credits. And tax credits are used to reduce on a dollar for dollar basis a taxpayer's income tax liability. And there's typically a sponsor and an investor in energy tax credits. And so the sponsor kind of indemnifies the investor for any loss for the tax credits. So tax insurance has been used in this field quite a bit and is commonly used to protect kind of the tax equity investor at a high level. And if you're in this industry, or if work a lot with renewable credits, feel free to reach out if you want to discuss this one a little bit more. So I'll talk very high level of pricing. As I mentioned, it's between 2 to 4% of the limits purchased, and that's the all-in cost. It's a one-time premium payment, which sometimes people get insurance, they think of it like car insurance. So it's a one-time premium payment, which is paid at binding. Retention, which is kind of like a deductible, is generally only limited to 150 to 200 grand for contest costs. The policy period is a claims made policy, which just means a claim has to be made in 7 years. It doesn't have to be fully decided. There are limited exclusions, which are generally inconsistent filing positions and materially inaccurate misrepresentations, which are knowledge qualified, and a change in law or prospective change in law, unless that's what's being covered. And the placement, to Michael's point, is generally really quick because the companies are conditioned from doing M&A transactions for kind of deal time. So we've also done one in 3 to 5 days, and it's not efficient because everyone has to be on call and on demand, but generally in 2 weeks to 3 weeks, you can get something done pretty easily. The process is similar to the process that Michael outlined before. You engage us, you engage a broker, we get an NDA, we look at the issue, depending on what it is, we see whether or not we think we can get insurance for it. We draft a submission, we send that to the insurance market. We obtain a bunch of quotes back. We provide a summary of them to you with our recommendation of the top 1 or 2 to go with. At this point, there's no cost to the client to go forward to get insurance. After they do select an underwriter, there's usually a cost to that, anywhere between 35 to 50K for them to underwrite it. And that's kind of to pay their outside counsel. During that time, then just like Michael said around warranty insurance, there's a call scheduled for about an hour to talk with the client and their counsel. And these policies are also bespoke, although there are some terms that are generally the same in specimen policies that are out there. So during that time, we're also negotiating the policy. And kind of once that comes to a head or the deal signed or whatever, then you bind coverage and the final policy is issued. These are a list for people to review of commonly insured tax risks. There's definitely a lot of issues on here, but like I mentioned earlier, it's not just used for tax attorneys. It's definitely used in the M&A space, and we've seen some common things like S corps come up a lot, or REIT issues, but it can almost be used on definitely any U.S. risks and a lot of international risks as well, as long as on the merits. Attorneys or practitioners are basically at more likely than not or better, greater than a 50% chance of succeeding on the merits. Okay, I think that's that. And I'll turn it over to David and Michael to talk about contingent.
Awesome. Thanks, Matt. And I am seriously re-emphasize, if you have questions as I go through this, having conversations a lot more fun than sort of talking at a screen. So feel free to chime in, and Jessica, pose those. Would love to continue the conversation. So this is a topic that I love talking about. Michael and I, as he mentioned, have been partners in sort of building a rep and warranty practice for a number of years. But one of the very first things that he said when he was enticing me to leave the law firm life of stacking 6-minute bricks, as glamorous as I know that is for everybody sitting behind the computer right now, and into this world, was the creative things and the kind of blue sky that is available for what we call contingent and litigation risk insurance. And we have been building this and kind of at the front of building this market since it started, really. And so I like to think about this the exact way that Michael sort of set this whole thing up, which is there's known risk and there's unknown risk. So one bucket of known risk, Matt just talked about, like a known tax risk in which the insurer is going to take a position on whether the taxpayer has taken the proper position, or the IRS is going to find that, or the other taxing authority is going to find that the taxpayer took the improper position and impose a liability. So I am this contingent risk product is all the known risk stuff that's not tax insurance. Sometimes there's a little overlap there when you're actually talking about an active litigation or an active matter. But generally speaking, I'm not a tax practitioner. That's what Matt is and Jessica is, and I'm a litigator by training. So this could be anything. This could be a litigation pending against the company that's on appeal. This could be a litigation where it's pending against a company where the sort of reasonable value of the claim is $10 million, but the plaintiff, like all plaintiffs in the universe, is kind of overreaching and is seeking hundreds of millions of dollars. And this could be a successor liability issue where you're drafting a purchase agreement and you intend to leave a liability behind with the target, but nonetheless, there's some risk that by operation of law, the buyer could be named in the lawsuit as a successor in interest and thus responsible for that liability. This could be a veil piercing type scenario where your client is adjacent to the client that's the real party in interest, but because they're adjacent to that real party in interest, they're concerned they're going to get drug into this lawsuit unfairly and unrightly, and thus owe money. All those types of issues are possible here. These are blinking cursor policies, meaning they're fully bespoke policies where you are effectively taking the risk of a legal outcome out of the scenario and transferring that risk of a legal outcome to the insurance company. So why did I say legal outcome as opposed to like factual outcome or just dispute more broadly? So the reason that I did is because that's what underwriters are good at underwriting. Underwriters are good at reading the law. They have backgrounds a lot like a lot of the folks participating here and a lot of folks watching this presentation. They're lawyers by training who can pick who's right and who's wrong based on established facts. So one of the sort of hallmarks that we look for when we're evaluating whether a solution can be obtained in the contingent risk insurance markets is whether it's a legal outcome. So it's an identifiable legal outcome. And then additionally, in the lower left-hand corner of the screen, I've given you a couple of example, like sort of factors to consider when you're thinking about picking up the phone, which I would always encourage you to do, and giving us a call to see if something can be done. Think about this. Is it a relatively significant liability? Can I quantify it? Like, is there a worst case scenario such that I can sort of determine what the worst case scenario would be? Is it reasonably remote? And is there what's the motivation for shifting it? And if there's good motivation, it's reasonably remote, you can come to a worst case scenario, kind of a black swan scenario, but it's significant enough, meaning that it's enough to justify the time and effort to underwrite individual bespoke policy, then maybe it's worth it. So let's take these in turn. Significant, generally speaking, you're talking about somewhere between $500,000 and $1 million. Would you agree with that? $500,000 and $1 million of premium to get and cost to get the deal done. Because if it's much smaller than that, as you can imagine, then it's hard to get a number of outside parties and their outside counsel and everybody to dig in to take that risk. So generally speaking, we're looking for risk where the kind of worst day is at least $7 to $10 million, something in that area.
Yeah, we've done some 4 or 5 million ones though. When we were talking about rapid warranty insurance, we said $10 million of limits, $500,000 of cost. We start with premium here because, and that's how much you pay for the insurance, because the risk can vary so widely. So you could legitimately have like a $3 or $4 million risk that the appropriate premium as determined by the markets gets you to those numbers. And so you need to be in a spot where the risk is worth it to you or your client to pay that much money. And otherwise it's hard to build something.
And just to chime in on tax, it's somewhat similar. It's usually about $2.5 million of a tax issue. And then with interest penalties and perhaps contest costs and gross up, that usually gets you to 4 or 5-ish of premium needed, which kind of gets you to the insurer's minimums.
So reasonably significant, the way I kind of think about it is if there's at least $500,000 in the deal to pay for the insurance and pay for the underwriting, then it's certainly worth a discussion. Quantifiable, that just means it's not a lawsuit that you just got filed, but you have no idea what the possible exposure is. So a brand new tort lawsuit with no damages analysis, not a good one. After trial, where there's been dollar motions over damages and everybody sort of agreed, that's much better. Reasonably remote, if you think you're going to lose, the insurance market thinks you're going to lose too, because these are all very smart folks that are underwriting these deals and they're going to get to the same result. So that's not a great one. And then a timing or strategic reason, this is probably obvious, but insurance carriers and underwriters don't want to be the dumb ones in the room. So they want to know why you want to shift the risk. Is it if it's because it's gumming up a refinancing, or it's holding up an M&A deal, or there's another strategic reason like monetization, which I'll talk about in a second. That's great motivation. If it's I'm scared of a lawsuit, that's a bad motivation, right? So that maybe we'll flip to the next screen. I will say this, I mean, this is a real product. This is not like on the edge of insurance anymore. I mean, we did $2 billion in limits last year. So this is real. So here's a couple of examples. I won't belabor these, but seller preparing for an auction. Imagine you're about to open up the data room and you discover an issue that seems remote, it seems preposterous, but it's severe and it's quantifiable. In that instance, we've wrapped those risks and taken them completely off the table.
We've been overbilling government Medicare for 10 years, and we're trying to fix it, but we just can't get the confirmation from the government that we're off the hook. They
Yeah.
won't release us formally from liability, things like that, where we gotta sell our company. We know no buyer is comfortable with this risk, but we think it's something we can transfer.
Yeah, that's exactly it. We actually did that deal. So, I mean, that's a real life example. Same thing, parties in an M&A transaction, you're buying, you're the buyer and you're about to buy a seller target and they have known regulatory exposure that no one's called them on, or maybe there's a lawsuit with a cap, but the plaintiff's seeking a lot more. But the parties just can't see eye to eye. To sort of go back to Matt's point, the seller thinks it's nonsense. The worst day in court is a couple $1 million. The buyer says, yeah, but the worst day in court could be $20 million, and I'm not taking that risk. But they don't see eye to eye. Who's going to bridge the gap? You know, you transfer the delta risk out of the deal onto an insurance carrier. The last two are kind of my favorite because this is the secret sauce that's made our team very, very successful over the past couple of years. But a claimant with a significant judgment. So imagine you represent a plaintiff or hell, a defendant, and you represent a plaintiff. You just won $100 million. Everybody is high-fiving each other in the hallway. And then the guy on the appellate team or the gal on the appellate team comes down the hall and says, well, now we've got 5 issues on appeal and years of fighting the appeal ahead of us. One thing that we have been able to do in those instances is set a floor value for your judgment. So you recovered 100, we go to the insurance markets, we guarantee that you will recover 90 of your 100. And then we've created a legal asset with the judgment plus insurance that therefore is very strong collateral for a loan. So it basically looks like litigation finance, where except it's playing in the upper echelon of the best risk in the market, where the litigation finance industry kind of struggles to.
And your borrowing costs are much better for you by doing this structure compared to some other structures. There are a lot of nuances to how that plays out there.
But yes, we did that play a bunch last year, where a very favorable judgment, there's very few de novo issues on appeal. It's a really strong footing for the appeal, and our client needs money now, either to continue to fight or to pay LPs or to pay or to buy equity back if it's a corporation, any kind of reason that they could need money now. But litigation finance seems expensive to them, so this is kind of an alternative to that. And then same thing on the defense side. You won the judgment, you defeated, you beat them out on summary judgment, but now they're continuing to come after you, and your client wants to do other things with this business, and it wants to route that risk and focus on other aspects. And then law firms or finance groups with a pool of value assets, exact same play, but instead of a single case, think about it as a pool of cases. So you want to guarantee that big law firms, these 8 cases are going to return at least $30 million. Let's wrap and create a floor value to those 8 cases as opposed to just 1 case.
And this is where you get into the plaintiff's lawyer, plaintiff's side world. A lot of what we talked about before is really, big law firms. I think here it touches on a set of law firms that sometimes operate in a little bit different space.
Totally agreed.
And by the way, I would say, and I was just thinking this as David was describing it, all of these have something in common, which is they have an articulatable, if that's a word, justification for insurance. So we can go to an underwriter and say, here's why the party wants to transfer this risk. It's to borrow money at a better cost. It's to close the deal. It's to make their company they're selling more attractive to buyers. Instead of, I just got sued and I'm really scared something bad's going to happen, so can you please take the risk instead? Which, as David said, is not a good way to get insurance done.
Agreed. I think I kind of covered a lot of these, but these are examples. These are kind of, if you want to put them in this bucket, these are the products. Again, these are all bespoke, created policies, which is why you should work with a broker that knows what they're doing, that knows what the terms are, and they can craft these. If this stuff is news to you and you've never heard of it or seen it, that is not at all surprising. This is a brand new industry that's really growing fast. But these are some of the tools in the toolkit, or to use Matt's earlier term, arrow in the quiver. So if you're a practitioner, whether you're a litigator or an M&A practitioner, think about these as tools in your toolkit. And if you see something and you say, I wonder if that's possible, that's when a telephone call is worth making. So here's 2 case studies. Let's see how much time we have.
Yeah, we're kind of running up. I mean, from my perspective, I was kind of thinking we have some claim studies and case studies as more leave behind, or as a appendices to this. You want to touch on that? I don't want to cut you off. but
These are great. These are a couple of case studies, which I would encourage anyone that's even remotely interested in here. I find these fascinating. And then in the appendix, there's even more examples of the deals we've done over the last 2 years. And if any of these sort of strike a chord or raise an idea, again, let's look for a follow-up conversation.
Jessica, do we have any questions from anyone? None yet?
We do not. We are happy to answer them if anyone has anything.
While we're waiting on that, I'll say, I assume that everyone has access to this this deck. If you're interested, we really think about, so what David just said, right? We have those 2 contingent risk examples. Fascinating stuff. We built those from scratch. We sort of figured that out as we went. And we're really excited about all the cool things you can do with contingent risk insurance. So take a look at those. Feel free to reach out outside of this context to ask questions. I would also say on the rep side, we have a claims example in there as well. We really think about rep and warranty insurance from the perspective of it's only as good as the claims it pays, right? And we don't really have time to get in the weeds here, but essentially this was a very quick and efficient resolution of a claim where a pipe started leaking right before the coverage was bound. And then coverage is bound, and then buyer discovers pipe is leaking and the damages associated with that. And we resolved the claim, got a check written to our client in 3 or 4 weeks, a pretty short amount of time before going through a process like that. And so if our clients buy a bunch of rep and warranty insurance and never get, have a claim and then it's a pain to get paid or it doesn't get paid, we're out of a job pretty quickly. That's just this industry can't operate like that. And so while the process is important and it can't slow down the deal, where the rubber really hits the road on reps is claims. And so this is a good example on a midstream deal. And we have a lot of other ones. We're happy to talk about those too.
Well, we are right on time. I want to thank you very much, Michael, David, and Matt, for taking time to do this. It's been very, hopefully, informative to everyone in the DAYL CLE committee. Just want to thank everyone for being here today, and we look forward to seeing you again next time. And please reach out with any questions you have.
Yeah, thanks for everybody's time.
Yeah, thank you.
Thanks.
Bye.